Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen & Partners, to our regular strategy update. This week, I want to look at, is there any limit on the extraordinary levels of government borrowing we are seeing today? Will they march hand in hand with monetary policy and central banks who are buying most of the newly issued bonds? And can we keep intervening on the sort of scale we are to protect underlying economies without fallout somewhere else in the financial landscape? Obviously, the key driver of this short term is how much support global economies need from central government, and this is dependent on the level of lockdown. Our regular stringency index here still showing numbers above 50% from everybody with the exception of Spain and Italy, who are just below. And an economy, even where the numbers are quite good, like China, stringency levels still high. And I'm afraid we've got to face also 227,000 infections in the last 24 hours. Again, another global record. With that in mind, let's look at our key indicators to see how much likely intervention governments are going to need to make. It's broadly, tentatively, I'd say, good news. On the top level, inflation expectations in the US creeping steadily up, which is good at 156, the 5-year forward rate, not forecasting what I would call deflation or depression. The dollar index weaker. Remember, that was a big problem in 08-09. The dollar surged, sucking liquidity out of international markets. That's the reverse this time round, which is good for international liquidity. On the top right, the Italian-German bond spread at 166. That's below the level pre-virus. That's a huge achievement for the ECB and the Commission under Ursula von der Leyen, much more European stability. And finally, the German IFO business survey. I use that as a proxy for world trade. Sentiment in the world's biggest manufacturing exporter gradually improving. Now, to look at the impact of spending and borrowing, I've looked particularly at the UK because we've just had a swathe of figures. First of all, the underlying UK economy is recovering. That's manufacturing surveys, bouncing above 50. That shows that just marginally more respondents reported better conditions this month than last month. But on the right, in a very influential speech from Andy Haldane, chief economist at the Bank of England, he looked just at the scale of the drawdown we're going to expect for Q2. Those blue bars are the distribution of normalised GDP, somewhere between -2 in a very bad year and +3, +4 in an exceptional year. Right back to 1955, and look at the number on the left-hand side of the chart. That's the bank's projections for Q2 2020, a fall of more than 20%. In fact, 18 years of growth wiped away in just one quarter. That's the magnitude of the drawdown that Chancellor Sunak's dealing with in his huge spending programs. He's already, in April and May of this year, borrowed 103 billion against 16 billion for the same period last year, and the June numbers are going to be even larger. The overall public sector deficit at 300 billion projected then, I think it's going to be more like 350, 360 against, say, 60 billion last year. So these are the largest numbers ever seen in peacetime. HMR tax receipts have also collapsed, down 43% in May. That's principally the VAT holiday. All of that has taken debt to GDP over 100.9% of figures. And some of the individual numbers are absolutely extraordinary. The Financial Times this week reported that on its estimates, the budget for PPE protective equipment is larger than the combined budget of the Home Office, the Foreign Office and the Treasury. Just the money spent on track and trace is larger than the budget of the Department of Transport. So can these sort of extraordinary payments continue? Well, they can, because the Bank of England is buying a lot of the debt. The yellow diamonds are issuances of gilts from the Debt Management Office. The blue bars are the asset purchase facility of the Bank of England. So that's the Bank of England on the other side buying those gilts. So they're buying more even than the government is issuing. And this is a similar picture the world over. Now, for a period, that's not a problem. The Central Bank of Japan has showed you can run this sort of policy for a couple of decades without crisis unfolding. But in the UK's case, it is taking the Bank of England balance sheet to extraordinary scale. Again, from Andy Haldane's speech, he's looked right back to 1700 at the percentage of GDP that the holdings that the Bank of England represent, this is the accumulated pile of gilts and corporate bonds from their purchases, 20% are back in the South Sea bubble in the 18th century, to a little over 20% at the end of World War II, 45% today. Now, that in itself is not a challenge, but it does mean that credibility and particularly independence of the Bank of England are key. If it was perceived the government is forcing this response, that could trigger a very different response for investors. Already these policies around the world are, of course, prompting investors to look at other assets. And the key security for this sort of policy is obviously gold. Now you can see on the left-hand side, half-yearly flows into gold exchange-traded funds, ETFs. H1 2020 was the largest number on record. In fact, it was larger than all the central banks put together buying gold in 2018, which was itself the biggest year. That's on the right, taking gold within a whisker of its 2011 highs as interest rates around the world begin to fall away. So what does this mean for investors? Well, the central bank action is continuing to inflate asset prices. Gold up 24%, gilts up 9%, the World Equity Index in sterling actually up for the year to date. Looking at the second quarter, a staggering rally in the World Equity Index, on the right-hand scale up almost 25%. But look at US 10-year bonds. The yield is actually lower. Financial theorists, just as equities rise, bond yields should typically rise. In this case, they're falling, and that's, of course, the suppression of central bank activity. So what does that mean for our strategy? It means continuing our slow but steady underweight of gilts because of issuance risk and super low yields. As I said, today's yield on the 10-year at around about 13 basis points is pretty well the lowest in recorded history. Underweight gilts, overweight corporate credits. Neutral equities, overweight global, underweight EM. And again, to escape from that drawdown of central bank pressure, more alternatives, and particularly holding our big gold positions. Thank you.